So welcome to our day's session. My name is Mitema Emmanuel, and today we are going to see an overview of portfolio management. Portfolio management is a subject or rather unit in intermediate level that's for those people who are taking CIFA. And so what's portfolio management? So portfolio management is the selection and prioritization and control of firms' projects in line with its strategic objectives and capacity to deliver. You find that, for example, in these very big companies, they may have a different kinds of investment. It can invest in shares, it can invest in different types of securities, that is, it can invest in real estate, it can have investments in commodities. So you find that all those classes of investments, they need to have a strategic objectives and a strategic plan, and there's a way that they are selected and they are given different priorities depending on the project itself and probably its return. So the whole scope of selecting, giving it the required priority, the control of the project, and in line with its strategic objectives is what we call portfolio management. Now you find that portfolio management, it's a process. It's a process that takes time to deliver. It's a lengthy process. It has its own steps. Number one, there's the planning step, whereby you must understand the client's needs. You must understand the client's needs or our objectives. What are the client's needs? What are the client's objectives? Some clients, they want an investment which is liquid. Some clients want to invest in long-term investment. Someone wants to have a short-term investment. So you first of all, you need to understand the client's needs. Number two, after you have understood the client's needs, then you need to look at, or you need to prepare what we call investment policy statement. Investment policy statement, these are statements that elaborates the plan which you are going to follow, so that in order for you to meet the objectives of the clients as he or she has stated, that the objectives or the needs that she wants to attain. So you need to understand the client's needs, and then you prepare the statement which we call IPS, Investment Policy Statement. This statement is more of like a booklet. We're going to look at what it entails later on, I think, again in this session. And then number two, in the preparation of or other portfolio management, we have what we call the execution step. After you have understood the client's needs, its objectives, be it a short-term investment, a long-term investment, and then you have prepared the investment policy statement. This is the statement, or rather a book or a document that's going to guide you on the execution of your client's needs. Then now you need to execute the objectives. First of all, we have what we call asset allocation. This is the allocation of assets into different classes. You have said that it could be into securities, it could be into commodity, it could be even to real estate. So you allocate assets to different classes of investment depending on the priority and the project's requirements. Secondly, you do what we call security analysis. You analyze the security market, how it is performing. Is it the right time to go to an investment, or you have to wait for the market to stabilize? So you need to check or do what we call security analysis, and then you need to do what we call portfolio construction. Now, portfolio construction, after you have done asset allocation, security analysis, portfolio allocation or construction is going to guide you on the execution of these all projects that you have selected. And then after you have done all these, you have executed your project, you need to have another final step, which is called the feedback step. This is where you monitor how the execution is going on. And then if there need be of rebalancing, probably you need to allocate more funds, or you need to allocate more, or really do a buyout or withdraw some funds from the project. This is what we call rebalancing. You monitor and you balance, and then you do what we call performance measurement. Performance measurement is you measure the performance of your project, and probably you are going to use what we call the benchmark. You need to compare the performance of your project in regards with the market, the performance of the market performance, and also you need to do a reporting. After you have done the performance measurement, you need to report how the market is performing, how your project is performing. With the benchmark is what you use to establish, is like a marking scheme on which you are going to use to checklist the performance of your specific project. So this is the process of portfolio management. First of all, you need to understand the objectives of the clients. The clients have different objectives. Secondly, you need to establish or prepare an investment policy statement, which is called IPS. You do execution of asset allocation and security analysis, and then you construct the portfolio. And after that, you're just going to look to do a portfolio report monitoring and a rebalancing. You monitor the execution process. How is it going? Is there a rebalance that is supposed to be there in terms of maybe the capital? You do. Then you measure your project. You can use a benchmark, or you can use the current market performance, how it is. If it's a security, you can compare your security, how is it performing in regards to the market performance of the similar securities. You can also what we call peer performance check of other companies in the same industry. So we say that in the planning, after you have understood the objectives of your clients, then there is issue of preparation of investment policy statements. So an IPS is typically a document that is going to give you a guideline on how or the steps on which you are going to follow to meet your client's needs. And it may include the following elements. It may, the IPS, that's the investment policy statement, includes a brief description of the client's description, so that the client description. Number 2, it will have the purpose of establishing policies and guidelines. So the purpose, policies, and guidelines. The statement of investment goals, objectives, and constraints. So it will have the goals, that's the investment goals. what we call investment goals, objectives, and constraints. It will able to highlight different duties of different parties. So it will highlight different duties of different parties, that is of a portfolio manager, as maybe the duty of a portfolio manager and maybe the client. Their duties will be highlighted in the IPS. It also includes the performance measures, what we call the benchmarks. So performance measures, the criteria on which you are going to measure your performance. So performance measures and what we call the benchmarks. So also to include any other considerations in developing the strategy asset allocation. So actually these are the key points which you will find which are included in the IPS, that's investment policy statement, the client's description, the purpose, the policy and the guidelines, the investment goals, objectives and constraints. It will highlight different duties of different parties involved. That could be a portfolio manager, because when you are doing a portfolio management, you are trying to be a portfolio manager, and a client. Also, it will also able to include different performance measures. We said that the final stage in the preparation or in the portfolio management preparation is the performance measurement and reporting. So it will be able to give you the criteria on which you are going to use to measure your performance of maybe your investment or your project. So you find that we have different types of investors. We have different types of investors. We have individual type of investors. Types of investors. So we have individual investors, we have institutional or institutions, we have foundations and endowments, we have number 4, banks. Number 5, we have another is insurance firm. We find that again in these types of investors, individual investor will have different objective to compare to the objective of institutional or banks or insurance firms. Every category or type of an investor has its own different needs or objectives. So first of all, that's why we said a portfolio manager will have to understand the client himself and his or her requirements or needs that he needs. So again, we find that when a portfolio management is to planning all these kind of projects, first of all, you will have to analyze what we call the risk and the return. This is the first thing that is going to be checking if the investment, different projects that he wants to get himself into, what are the risks which are involved there, the exposures, if they are, and probably the return on the investment. In our subsequent lectures, we are going to look at the risk and investment. Now let us look at different types of pooled investments. Different types of pooled investment products. Pooled investment products. Pooled investment products. Number one, we have what we call a mutual fund. A mutual fund is a pooled investment product. We have hedge funds. We have what we call hybrid or balanced firms. We have the stock traded funds, there are many. And also we have what we call the venture capital and buyout private equity funds. So you have said we have the mutual fund, we have the hedge fund, but today we have the exchange, what we call the exchange traded funds. And four, we have what we call the separately managed accounts. Separately managed accounts. So let us look at the mutual fund. A mutual fund is a type of a commingled investment pool in which investors in the fund have a pro rata claim on the income and value of the firm. So this is a pool. A mutual fund is a commingled, commingled investment in which investment pool in which investors in the fund each have a pro rata claim on the income and the value of the fund. The value of the fund is referred to as the net asset value, and it's computed daily based on the closing price of the securities in the portfolio. So we find that the mutual funds are one of the most important investment vehicles for individuals and institutions. So you have said this is a commingled investment pool in which the investors have a pro rata claim on the income and value of the fund. Then you have find that the mutual funds, you have different types of mutual funds. You have different types of mutual funds. They can be categorized into a mutual fund. They are categorized into one, what we call money mutual fund, money market fund. Number two, we have what we call the bond mutual fund, the bond mutual fund. Number 3, we have what we call the stock mutual fund. Number 4, we have hybrid balanced funds. So you have said that a mutual fund is a commingled investment pool in which the investor has a pro rata claim on the income and value of the net assets. And when you say a pro rata claim means that it's going to have a claim depending on the amount of money invested in that pool. You have said that the mutual funds, they are also categorized into 4. We have money market fund, the bond mutual fund, the stock mutual fund, and hybrid, or rather the balanced mutual fund. So what does it, let us look at number 1, the market fund. Money market fund. So money market fund is a kind of a mutual fund that invests in highly liquid near net instruments. Money market fund is a kind of a mutual fund which invests in highly liquid, we say money market fund. They invest in highly liquid near-term investment. Near-term investment. These instruments may include cash equivalent securities, and high credit rating or debt-based securities with a short-term maturity. Now, the instruments which are traded or invested in the money market fund, they may include cash equivalent securities. It also may include high credit rating instruments. It may also include what we call the debt-based securities with a short-term maturity. So we find that the money market funds are intended to offer investors high liquidity with a very low level of risk. The intention of this is to offer the investor high liquidity with a low level of risk. So a money market fund may invest in the following types of debt-based financial. We say that one of the instruments that is involved in the money market fund is what we call the debt-based securities. Debt-based securities. Now, these securities may include what we call the banker's acceptance, certificate of deposit, commercial paper. We have what we call the banker's deposit, the banker's acceptance, what we call BA. Also, we have certificate of deposit. Then we have commercial paper. And lastly, we have what we call the repurchase agreement. Repurchase agreement. So these are the debt-based instruments which are involved in the money market fund. You have the banker's acceptance, the certificate of deposit, commercial paper, and repurchase agreement. So what is a banker's acceptance? This is a short-term debt guaranteed by a commercial bank. So it is a short-term debt issued or guaranteed by commercial bank. And the certificate of deposit is a bank issued savings certificate with a short-term maturity. It is a bank-issued savings certificate with a short-term maturity. A bank-issued savings certificate with a short-term maturity. The commercial paper is unsecured short-term corporate debt. It's unsecured short-term corporate debt. Unsecured short-term corporate debt. And then the repurchase agreement is the short-term government securities. Repurchase agreement is a short-term government securities. Now, let us look at other types of mutual funds. We say we have a bond mutual fund. This is a pooled investment vehicle that invests primarily in bonds. So, as the name suggests, this is a pooled investment vehicle which primarily invests in bonds. Again, we have different types of bonds. We have the government bond, the municipal bond, the corporate bond, we have the convertible bond, and other types of debt. Again, the bond mutual fund holds bonds with maturities as short as 1 year, or can also be as long as 30 years. So for this is short term out of the debts which are treated in the money market fund, but the ones we have seen, the government bond, the municipal bond, the corporate bond, they are mostly can range from short term for 1 year to a long term period, which is can go as far as 30 years. Then let us look at the third type of a mutual fund, which is said is a stock mutual fund. A stock mutual fund, it is a fund whereby the stock or the investment is primarily done in a stock. So it's also called an equity mutual fund. So this is a fund whereby the funds or the fund invests primarily in stocks. And then we have you can have the actively managed funds and the passively managed funds. So lastly we have the hybrid or the balanced funds. The hybrid balanced funds, this is where these are the mutual funds that invest in both bonds and shares or in stock. These are the mutual funds that invest both in bonds and in stock. So they have both features of stock and bond. So let us look at another investment product we have. We said we have the exchange traded funds. So mutual fund was number one type of a pooled investment product. So that was number one. Let us look at the number two, which is called exchange traded funds, commonly referred as ETFs. It's number two. So what's an exchange traded fund? Now, this combines features of closed-end and open-end mutual funds. An ETF is a type of security that tracks an index, sector, commodity, or other assets, but which can be purchased or sold on a stock exchange the same way as a regular stock. So you say that an ETF is a type of security that tracks an index, sector, commodity, or any other asset, but which can be purchased or sold on a stock exchange the same way a regular stock can. Examples, we have bonds, ETFs. Examples of these: commodity, Utaniambia ukianza. Endelee. So exchange traded funds, we have said that these are a type of security that tracks an index, a sector, a commodity, or assets, but which can be purchased or sold on a stock exchange. The common way stock can be sold or purchased. We say that we have the bond ETFs, the stock. These are examples of ETFs we have. We have the industry ETF, we have the commodity and the currency. The currency, the industry ETFs, the commodity and the currency. So let us look again at another example of approved investments. So we have the separately managed account, what we call SMA. Number 3, you have the separately managed accounts, SMA. So an SMA is an investment portfolio managed exclusively for the benefit of an individual or an institution. A separately managed account is an investment portfolio managed exclusively for the benefit of an individual or an institution. The account is managed by an individual investment professional to meet the specific needs of the client in relation to the investment objective, risk tolerance, and tax situation. The account is managed by an individual investment professional to meet the specific needs of the client in relation to investment objectives, the risk tolerance, and tax situation of that client. So we find that in an SMA, that's the separately managed accounts, the individual's shares are held directly by the investor, and in return for an annual fee, an individual can receive personalized investment advice. So the shares of this client or investor, they are directly held by the profession, and in return, the profession is paid an annual fee. Again, at the same time, is entitled to some investment advice from the investment professional. Then let's look at the hedge funds. What's an hedge fund? Hedge funds are actively managed investment pools whose managers use a wide range of strategies, often including buying with borrowed money and trading esoteric assets in an effort to beat average investment returns for their clients. These are actively managed investment pools whose managers use a wide range of strategies. So there's a use of strategies, wide range of strategies. Again, they can trade. These strategies may include buying with borrowed money and trading what we call esoteric assets. The strategies include buying with borrowed money, also it can include trading esoteric assets in an effort to beat average investment returns for their clients. So the main objective here is to beat the investment returns, or the average is to gain more for their clients. They are considered risk alternative investment choices. but they charge much higher fee than the conventional investment funds and require high minimum deposit. So they charge higher charge cost than other funds. Again, they require higher minimum deposit. They require a higher minimum deposit. So these are actively managed investment pool whose managers use a wide range of strategies, often including buying with borrowed money and trading esoteric assets in an effort to beat average investment returns. They are very risky and there's an higher charge cost compared to other funds, and also there is an higher minimum deposit that is made. So, and lastly, let us look at what we call the buyout funds. Number 5, the buyout funds. The buyout funds, the essence of the buyout fund is that it buys all the shares of a public company, and by holding all the shares, the company becomes private. So here, a firm or an investor, it can buy all the shares of a public company, and by holding all the shares, the company becomes now private. In its current form, private equity firms raise money specifically for the purpose of buying public companies, converting them to private companies, and simultaneously they do what we call the restructuring of the company from the executive even to its operations. So those are the 5 types of pooled investment that we have in portfolio management. And lastly, you can look at what we call the venture capital funds. These are the funds that provide financing for companies in their startup phase. You can include here what we call the venture capital funds. Venture capital funds. So they provide financing for companies in their startup phase. They could provide financing for companies in their startup phase. They play a very active role in the management of the companies in which they have invested. They play a very active and vital role in the management of the companies in which they invest and provide close oversight and advice. So the venture capital funds make the investment with the intent to exit in 3 to 5 years. They make the investment with the intent of exiting the business in 3 to 5 years. So the funds make a large number of small investments with expectation that only a small number will pay off. They actually, these kind of funds, they actually finance a lot of small firms so that in case the small number of, a small firms, but a bigger number of them, so that in case one fails, still one, the other firms will be able to get them their money. So let us look at the basics portfolio planning and construction. Let us look at what we call basics of portfolio planning and construction. So what are the basics of portfolio planning and construction? I remember we said that portfolio planning is one of the first steps in the portfolio management. So portfolio planning, so what's portfolio planning? Portfolio planning is a program developed in advance of constructing a portfolio that is expected to satisfy the client's investment objectives. So this is a program, or rather plan, that is developed in advance of constructing a portfolio that is expected to satisfy the client's investment objectives. When we say that, the written document governing this process is called the IPS, a written document that governs this process of portfolio management is called an IPS. That's the investment policy statement. So the IPS essentially communicates a plan of achieving investment success. An IPS, it communicates the plan of achieving investment success. So the IPS will be developed following a fact-finding discussion with the client. That's why we say that one of the elements of an IPS, it entails the description of the client. So there is that aspect of fact-finding or understanding the clients, its objectives, and again, you together with the client, that's the portfolio manager together with the clients, they come together, they have a discussion about their portfolio, and then from there they can be able to plan or have a program of their portfolio. So this fact-finding discussion can include the use of questionnaire designed to articulate the client's risk, tolerance, and as well as specific circumstances. So in case of institutional clients, the fact-finding may involve asset liability management studies, identification of liquidity needs, and a wide range of tax and legal consideration. So you find that we have different types of investors. We can be an individual investor, institutional investor, a bank, and insurance. So every group of investors, it has its own category or it has its own features. Now, the approach which is going to be taken when you're developing a portfolio for an individual investor is not the same as to when you are doing a preparation for maybe a bank or even an institutional investors. They must be different. Some of them, they involve different types of risks. Some of them, they involve different types of tax. Some of them have different legal compartments. So it's different. So that's why, first of all, you need to understand the clients. Is it an individual or a bank or an institution? And then its objectives. You can define even is the constraints in terms of the legal compartments. So IPS can take a variety of forms. A typical format will include the client's investment objective and the constraints that apply to the client's portfolio. The client's objectives are specified in terms of objectives are specified in terms of risk tolerance, and what we call return requirements. Return requirements. We find that we have different types of risk behavior. Some of people are not willing to take risk. You have different types of, you have the neutral, you have to what we call the adverse. So you have everybody, or every individual has a different types of risk trajectory. So first of all, you must understand, is the person willing, and does he really have the capability of taking a certain risk? And then you must look at the return requirements of that individual. What are his return requirements? And then lastly, the constraints. So there's aspect of objectives, and then there's the constraints. The constraint section covers factors that need to be taken into account when constructing a portfolio for the client that meets objectives. So these factors may include liquidity requirement. So constraints may be the liquidity requirement. Then we have time horizon. Time horizon. Then we have legal requirements. Different investments, they have different legal requirements. We have what called the tax status. And also, lastly, what you call the unique issues or needs. The unique needs. The constraints, so we say that these are the factors that one needs to take into account that probably, if not well evaluated, can kind of affect your portfolio. They include the liquidity requirement, time horizon, legal requirements, tax status, and the unique needs. So the constraints may be internal or external. So some of them, like, they can be set by the client. That's when we mean internal, set by the client. For example, the liquidity or even the time horizon. The clients may want to invest in an investment where that the money, it's more liquid. Like we said, if we want to invest in money market funds where it's highly liquid. Also, it could like to invest in a short-term investment plan. That's the time horizon. So those are maybe the constraints that can be internally generated by the investor or the client. And then we have other external factors, which there are laws and regulations which are out of the compartments of the client, like these, the legal, the tax. These can be set by the government, or that they are the policies and the regulations which are set by the government through probably the acts of parliament, acts of companies, and what have you. So lastly, let us look at the major components of an IPS. I think we said it must include the introduction, where it describes the client, the statement of purpose, the section that states the purpose of the IPS, the duties and the responsibilities of different participants, that is the portfolio manager and what we call the client himself. Then you have the procedures which are need to be followed, the objectives, the constraints. The objectives and the constraints must be included in the IPS. Also the guidelines. This is where it provides the information about the policy, how the policy should be executed, and specific types of assets included from the investment, if any. Also, you have the evaluation and the review. Now, one of the most, we say that in portfolio management, things that the portfolio managers, they are keen to check is the risk and the return. So you have different risk objectives. So the risk portfolio should be suitable for the client. First of all, it should be suitable for the client, and then the IPS which you are constructing should state clearly the risk tolerance of the client. We said that people have different risk tolerance. Some of people, they are ready to and willing to take high risks. Some they may shy off or away from taking those risks. So it must clearly state the risk tolerance of the client. And the risk objectives are specifications for portfolio risk that reflect the risk tolerance of the client. Quantitative risk objectives can be absolute or relative, or a combination of both. Again, risk tolerance, we said, is a function of the client's ability to bear, to accept the risk, and his or her attitude, which might be considered as the client's willingness to take risk. So there is that ability to bear. Risk tolerance is the ability to bear. And again, the willingness to accept. This is another thing that one needs to check, the risk tolerance. And again, the ability to share, or rather ability to bear risk, is measured mainly in terms of the objective factors such as the time horizon, expected income, and the level of wealth relative to liabilities. So the ability of one to bear an high risky investment is measured by the income, the return. Probably when the risk is high and the return is high, someone will be willing to bear that risk, because at the end, he or she will have a good return. But when the return is low, the risk is high, then no one is to be willing to have that kind of portfolio. And then we have, again, what we call the time horizon. How long is this investment going to take? How long is this kind of risk going to be in existence? Number 3, the level of wealthy relative to liabilities. If you find that this investor is a wealthy individual and has a lot of wealth at his or her disposal, then the liabilities, he or she will be willing to take high risk investment alternatives. And then now let us look at the return, the objectives, or the return of objectives. And there we say that a client's return objectives we have already looked at the risk objectives, and we say that risk and return is what portfolio managers, they are really concerned about. We have said that for the risk objectives, we must indicate the risk tolerance of the client. That's the ability to bear and the willingness to accept. and this can be measured by the time horizon, the income or the return which he or she is expecting, and the wealth of the person at his or her disposal against liabilities. Now, the return objective is also another concern. The client's return objectives can be stated on an absolute or relative basis. So, the return objectives can be stated also in a relative and a absolute basis. Again, we say that the benchmark could be an equity market. When you are going to have the performance measures of your portfolio, you are going to see, you are going to measure it against the return. How has your portfolio performed? Again, you are going to use has it given me a good return in comparison with other securities which are of the similar? So mostly people use what we call the benchmark. A benchmark could be an equity market index. So it could be a benchmark. This is used to measure or mark, for example, your return objectives. Have you outperformed the market, or has the market outperformed you? So mostly they use a benchmark. It can be an equity market index. So you have several of them. You have like the common, standard, and poor 500. You can check with that how other market indexes are against yours. We have what we call the Singapore. We have FYSE 100. These are some of the equity market indexes which you can check against your portfolio to see how its performance are. So you have seen that the major factors or types of constraints in a portfolio selection include the liquidity requirements, time horizon, legal requirements, tax status, and unique needs. Now, we have the aspect of construction of a portfolio. Construction of a portfolio. Construction of a portfolio. So once the IPS has been compiled, so this is the construction. Of portfolio. We see that once now you have compiled your IPS together with your clients, you have been able to identify its risk objectives, you have been able to identify the return objectives, and you have also been able to highlight the criteria on which you are going to measure the performance of your portfolio, be it going to use a benchmark, or what you can be using a peer measure to measure with other industries in the market, and companies or firms, the way they are performing. So once you have compiled your IPS, the investment manager can construct what we call a portfolio, a suitable portfolio. Then we have strategic asset allocation. It's a traditional focus of first step in the portfolio construction. Strategic asset allocation. So here you have strategic asset allocation. So this is the traditional allocation of or focus in the, and is the first step in the portfolio construction. So asset allocation in terms of, it is stated in terms of percentage allocation to asset classes. You have different asset classes. We can be securities in terms of equity shares, it can be commodities, it could be trading with bonds. So there's a specific allocation or strategic allocation of assets to different assets. So you have allocation of assets to different classes depending on their priority. So an asset class is a category of assets that have similar characteristics, attributes, risk, and return. So strategic asset allocation is the set of exposures to IPS permissible asset classes that is expected to achieve the client's long-term objectives given the client's investment constraints. So there is what aspect of strategic risk analysis, what we commonly is known as systematic risk, what we call systematic risk. Actually, you have systematic risk and non-systematic risk, but here let us look at this. This is the risk related to economic system, e.g. business cycle. It cannot be eliminated by holding a diversified portfolio. This risk is different from the other particular risk of an individual security, which may be avoided by holding other securities with offsetting risk. So this is one of the most important thing or analysis which must be done. This kind of risk, it affects the performance of the economy. So when the economy is not performing well, or the business cycle, then this risk cannot be eliminated by holding different classes of investment or by diversification of your investment. We find that the other non-systematic risk is the opposite of this. This is an which can be avoided by holding different classes of investments. So returns to groups of similar assets predictably reflect exposures to certain sets of systemic factors. So at this point now you have been able to construct your portfolio. Now after you have constructed your portfolio, you are going to do what we call risk and return analysis. So in our next lecture, we are going to have introduction to risk and return. What we have been saying that the most important thing that a portfolio manager must check in a portfolio is risk and return. So this marks the end of our lesson today. This is my number. In case of any questions, you can call or WhatsApp.